Okay, this is chapter 4, and in this chapter we're going to be focusing on cost, volume, profit analysis, and I think this is where the concepts in this course are really interesting and can really help management make great decisions. So cost, volume, profit analysis is a very powerful tool in helping managers make decisions, and it really helps management see the relationship between cost, volume, and profit and loss. And it helps you determine how much you must sell each month just to cover your costs or break even, and then it helps decide how much sales volume you're going to need in order to make a certain level of profit. So if you have an example here of Kay's posters. So Kay has a poster business, so she sells each poster for $35. The poster has a variable cost of $21, and the fixed cost for her business is $7,000. So she's currently selling 550 posters, but she can, in her business, she can make up to 2,000 posters if she feels she can sell them. So the contribution margin statement, here you're looking at, she sells her 550 posters for $35 each. Her variable cost, so that'd be her material, mostly her materials and labor, and her variable overhead. That comes to $21 times your 550 will give you $11,550. That results in a contribution margin of $7,700. And her fixed expenses, we're told, is $7,000. So she's only just barely covering her fixed expenses to come up with an operating income of $700. So that's not very profitable. So from the previous slide, we have the per unit information. So the selling price per unit, the variable cost per unit, and the contribution margin per unit. So we can take that per unit information, and rather than complete the full income statement, what we can do is take our contribution margin, the $14, and say, for instance, we're going to make now 650 posters. So we know the contribution margin for 650 posters will be $14 times 650, which is $9,100. Subtract off your fixed costs, you come down to an operating income of $2,100. So this is, by using your contribution margin, this is a really quick way to do what-if analysis. What if I made 650 posters? What would my operating income be? So it's just a quick shortcut to do a what-if analysis. So when you're looking at contribution margin, we just looked at it in terms of the contribution margin on a dollar basis, but you can also look at it on a percentage basis. So you can calculate the ratio. So here the ratio could be calculated per unit, so $14 divided by your sales price of $35, so that would give you contribution margin ratio of 40%. Or you could use the cost, and obviously you're still going to come up with the same answer, so 40%. So what we could do here is say, for instance, rather than saying how many posters she's selling, we want to say, what about if she has sales of $70,000, what will be her contribution margin? So contribution margin is 40% times your $70,000. So her contribution margin is $28,000 less her fixed cost, and this will give you operating income of $21,000. Okay. So you can double check that calculation by, recalculating each line item, but you can see it's obviously much faster just to use the 40% versus producing your full contribution margin income statement. So break even is when you're just making enough money, you just have enough sales to cover your fixed expenses. So your fixed expenses It's going to be equal to your contribution margin. And there's a couple of ways, of course, to calculate it. We can do the full method, the income statement approach, or we can take a couple of shortcuts. We can use the unit contribution margin, the dollars, or we can use the ratio, the percentage. So the income statement here, this is the full income statement where you calculate the revenue, your expenses, and so on to come down to operating income. Whereas the shortcut is if you're just trying to figure out what is the minimum number of units I have to sell just to break even, to cover my fixed costs. So the formula is your fixed costs plus your operating income divided by your contribution margin per unit. So we know our fixed cost is $7,000. We're looking for break even, so that means we want an operating income of 0. So 7,000 divided by your 14 contribution margin means you got to sell 500 posters just to break even. And if you wanted to look at it using in terms of the sales in dollars, again, what you're going to do is you take your 7,000 fixed expenses plus 0 for your operating income. But now, if you want to get the sales in dollars, you've got to divide by the ratio. Whereas if you want to get the sales in units, you divide by the dollars. So you just got to remember that. So now, what management really use this formula for is to figure out how much they would have to sell in order to make a targeted amount or a certain amount of profit. So here, if the company wants to make $4,900 in operating income, you're trying to figure out how many posters do they need to sell to do that. So you have your fixed expenses of $7,000. You want to make $4,900, so it's $11,900. Divide by your contribution margin per unit. So it's the per unit cost is going to be in your denominator because we're trying to get the number of posters. So that gives you 850 posters. So just to break even, or just to make $4,900, you need to sell 850 posters. The other way of doing it, if you want to figure out, looking at it in terms of sales dollars, then your denominator is going to be the contribution margin ratio, and that will give you your 29,750. So when management is doing, various what-if analysis, we call that sensitivity analysis. So you're looking at what happens if I increase or decrease my sales price? What happens if my, costs change, the product becomes more expensive, or I've had to enter into a new collective agreement with the employees, so my labor costs are going to go up. And of course, what happens if the sales mix changes? So we've been looking at examples where the company just sells one product, but that's typically not the situation. Companies are doing more than one product. So what about if the mix changes? You're selling more of product A than product B, etc. So the sales mix. So assume that K sells regular posters and large posters. So for every 5 large posters, or regular posters rather, she sells 3 large ones, so it's a 5-to-3 ratio. So we're going to look at the weighted average contribution margin in this situation, and then we're going to look at finding break-even and targeted profit for the sales, various levels of sales for each product. So the regular posters, we've seen these numbers already, the $35 per unit, variable cost 20, we know our contribution margin's 14. The large posters, they're selling for $70, the cost per unit is 40, so a contribution margin is $30. So they're selling 5 of the regular posters, and they're selling 3 of the large. So they have a total of $160 contribution margins for both products, and they're selling 8. So this is giving you a weighted average contribution margin per unit of $20 if you're selling 5 regular and 3 large. So what happens if you change your sales mix? And you want to look at what happens for break-even, for example. So here, if you have your fixed, if you're looking for break-even, you're going to have your fixed costs plus 0 operating, and your weighted average contribution margin is 20. So you need to sell 350 posters in total. So what we're going to do here is break this down so we know 5/8 of the posters will be regular size and 3/8 will be large. So we take our 350 posters and we're going to say 218.75. Now in real life you're not going to make 0.75 of a poster, you'd round up, but just for illustration purposes, we'll say for break even, you'd have to have like 218 posters sold and of the regular posters, and for break even, you'd need 131 of the large posters. And again, you can sort of prove this, so you take your 218 posters times $35 each, and then do the same for the large to come up with your total revenue. The other way of looking at it is in terms of sales revenue. So instead of looking for the number of posters, we're looking at the revenue. So you can see here the contribution margin for each poster is the same, the 70 and the 90 that we just calculated. The 160 is the combined contribution margin for both posters. Then you're going to divide that by your sales revenue, 385, to come up with your weighted average contribution margin. So that's the percentage you would use in your denominator. So here, if you're trying to calculate break even in revenue, again, it's the 7,000 divided by the 41%, which will give you sales of 16,844, rounded. So when you're doing analysis of profitability and what-if analysis and so on, there's a couple of common indicators of risk you need to keep in mind. So margin of safety. This is talking about how much you're making in sales over and above what you need for break even. So, you know, ideally you'd want to be well above break even. So the margin of safety is the difference between what you need to make just to break even and the difference between that and your actual salaries, actual sales. Operating leverage. This is the relative amount of fixed and variable costs that make up the company's total cost. So when you're looking at margin of sale, so this is the excess of actual or expected sales over break even. So if you have a drop in sales, it tells you how much a drop in sales you can have, how much you can absorb before incurring a loss. So if you had a margin of safety of, say, $10,000, then your sales can drop by $10,000 before you start losing money. So this is helpful in evaluating the risk of your current operations as well as any new business plans you might be considering. So margin of safety, so you can calculate it in terms of dollars or in terms of units. So going back to our example, if we had expected sales of 950 posters and we know we need to sell 500 just to break even, that means you have a margin of safety of 450 posters, which is fairly healthy. Or you can calculate it in dollars. So break-even sales in dollars. You subtract your break-even sales in dollars from your expected sales, and that would show you have a margin of safety of 15,750. So you don't want to cut it too close. The idea is you want a good margin of safety whereby if there was, say, a pandemic and their sales dropped, you know, you're not going to be at risk of incurring a significant loss. And as before, you can calculate this using your units. So you can do it as a percentage. And again, it's the same idea. You're going to come up with, you can calculate the break-even, your margin of safety in units as a percentage, 47%, or you can use it using dollars, and you're still going to come up with your 47%. So operating leverage, what this refers to is the relative amount of fixed and variable costs that make up a company's total cost. So this is calculated by taking your contribution margin, divide by your operating income. So what this means is for a given level of sales, the percentage change in operating income that will occur from a 1% change in volume. So it tells you how responsive your operating income is to changes in volume. So if you had an operating leverage of 1, that's a situation where you have no cost, no fixed cost. So just to illustrate, if you have 950 posters and your contribution margin of $14 each, it's 13,300 contribution margin. We recall our fixed expenses are 7,000, so this will give you operating income of 6,300. So to calculate your operating leverage, you're going to take your contribution margin of 13,300 divided by your 6,300, which is going to give you an operating leverage of 2.11. So this means that if the sales volume changes by 1%, the operating income will change by 2.11%. So that concludes the main points for Chapter 4. And again, make sure you review my demo video, my YouTube video, and do the quick check PowerPoints, and definitely make sure you practice those problems listed in the syllabus. So this concludes Chapter 4.